In August 2005, Phillip Bennett took his company public. The IPO raised $670 million. The underwriters were Goldman Sachs, Credit Suisse, First Boston, and Bank of America. The auditor was Grant Thornton. On opening day, the stock jumped 25%. REFCO was valued at $3.5 billion. The fourth largest commodities broker in the world, 2,500 employees across 14 countries. 2 months later, the company was bankrupt. What Goldman Sachs missed, what Credit Suisse missed, what Grant Thornton missed, what every investor on Wall Street missed, was that Phillip Bennett had been hiding $430 million in bad debts, not for a month, not for a year, for 8 years. Every quarter, he would move the debt off REFCO's books for one specific day, the reporting date. Then he would quietly move it back, every quarter, for 8 years. Through the most sophisticated auditors and bankers in the world, this is the story of the most elegant accounting fraud you've never heard of. Welcome to Ruins and Reason. Today, how one man hid almost $500 million in plain sight, took a company public, and ended up in federal prison for 16 years. Phillip Bennett was British, born in 1948 in Surrey, England. He went to Cambridge, studied economics, and joined Chase Manhattan Bank in the 1970s. Bennett was the opposite of a Wall Street stereotype. He didn't drive a Ferrari. He lived in a modest house in Gladstone, New Jersey. Colleagues described him as quiet, polite, almost shy, a numbers guy. In 1981, he left Chase and joined a Chicago-based commodities firm called Ray E. Friedman & Company. The firm had been founded in 1969 by Ray Friedman, a former cattle trader who built one of the first electronic futures trading platforms in America. The company name was shortened to its acronym, REFCO. By 1983, Bennett was Chief Financial Officer. By 1998, when the founder retired, Bennett became Chief Executive Officer. REFCO was successful, but it had a problem. In the late 1990s, the firm had taken on a series of customer accounts that turned out to be financially unstable. Some customers couldn't pay back what they owed. These bad debts piled up, eventually reaching almost $430 million. Bennett had 2 options: write off the bad debts publicly, which would devastate REFCO's reported earnings and possibly trigger a regulatory crisis, or hide them. He chose option 2. The reason was simple. REFCO was preparing to go public. An IPO with hundreds of millions in hidden bad debts was impossible. An IPO with clean books was worth billions. So Bennett designed a system. It was elegant in its simplicity, and it would last 8 years before anyone noticed. To understand the scheme, you have to understand how accounting works at a public commodities broker. Every quarter, the company has to file financial statements. Those statements include a list of who owes the company money, what accountants call receivables. If a customer borrows from REFCO and doesn't pay back, that's a receivable. If the customer can never pay back, it becomes a bad debt, and the company has to take a loss. Bennett didn't want to take the loss, so he invented a different solution. He created a private company called REFCO Group Holdings. The name was deliberately similar to REFCO Inc., but legally, it was a completely separate entity, owned by Bennett personally, registered offshore. Then Bennett wrote a series of transactions on paper. He had REFCO transfer its bad debts to REFCO Group Holdings, making it look like REFCO Group Holdings now owed the money instead of the original customers. On paper, the receivable was still there. It just had a new debtor, a company that, on paper, looked solid. But this is where it gets clever. REFCO Group Holdings couldn't pay either. It was Bennett's shell company, so the auditors would eventually figure out that the receivable was uncollectible. To solve this, Bennett added a third player, a hedge fund called Liberty Corner Capital Strategies based in New Jersey. Liberty Corner was a real legitimate hedge fund. They had no idea what Bennett was doing. Here's how the scheme worked. Every quarter, just before REFCO's financial reporting date, Bennett would execute a specific sequence of 3 transactions, all within 24 hours. Step 1. REFCO would lend Liberty Corner roughly $330 million. To Liberty Corner, this looked like normal prime brokerage business. They were used to receiving short-term loans from REFCO. Step 2. Liberty Corner would lend that same money to REFCO Group Holdings, Bennett's shell company. Step 3. REFCO Group Holdings would use that money to pay off its debt to REFCO. The end result, on paper, REFCO no longer had a bad debt from REFCO Group Holdings. Instead, REFCO had a clean loan to Liberty Corner, a real, solvent hedge fund. The receivable looked legitimate. The auditors moved on. 3 weeks later, after the reporting date had passed, the transactions would unwind. Liberty Corner would pay back REFCO. REFCO Group Holdings would owe Liberty Corner. Bennett would owe REFCO again. The bad debt would be back on the books, just not on the books that anyone outside the company was looking at. Then, 3 months later, at the next quarterly reporting date, the entire cycle would repeat. Bennett ran this scheme between 1998 and 2005, every single quarter, for 7 years. Liberty Corner had no idea they were laundering accounting fraud. They thought they were just executing routine money market transactions and pocketing a small interest spread. The transactions were enormous. By 2005, Bennett was moving up to $545 million through this loop every quarter. And nobody noticed. Not Grant Thornton, the auditor. Not Goldman Sachs, the IPO underwriter. Not Credit Suisse. Not Bank of America. Not Thomas H. Lee Partners, the private equity firm that bought a 38% stake in REFCO for $500 million in 2004, just 1 year before the IPO. None of them saw it, because the timing was perfect. The receivable looked clean on every reporting date. The debt only existed in the spaces between the dates, when no one was looking. This is the elegant part. It wasn't a complicated scheme. It was a simple scheme executed at exactly the right moments. By summer 2005, Bennett was ready for the biggest payoff of his life. REFCO filed for an initial public offering. The company would sell 26.5 million shares at $22 each. It would raise $583 million on the public offering, plus an additional $90 million from over-allotment options. The IPO date was August 11, 2005. The stock opened at $22 and ended the day at $27.5, a 25% gain in one trading day. REFCO was now a public company. Its valuation hit $3.5 billion. Bennett's personal stake was worth around $180 million. For 6 weeks, everything was perfect. Then, on the weekend of October 8th and 9th, 2005, a junior accountant inside REFCO ran a routine check on the quarterly accounts. What they found, by accident, was an unusual receivable, a $430 million loan that REFCO had outstanding, owed to REFCO by an entity called REFCO Group Holdings. The accountant flagged it. Senior management investigated. They quickly realized REFCO Group Holdings was owned by Phillip Bennett himself. The cover-up was discovered on Sunday, October the 9th. The board of directors held an emergency meeting. On Monday, October the 10th, REFCO issued a public statement. The CEO had been placed on leave. A $430 million receivable, owed by an entity controlled by Bennett, had been hidden from auditors. The market reaction was immediate and brutal. REFCO stock, which had been trading around $28, opened on October the 10th at $12. Within 48 hours, it was below $5. On Tuesday, October 11th, Phillip Bennett was arrested at his home in New Jersey. He was charged with securities fraud. Federal prosecutors revealed that he had told a colleague in a recorded phone call that he was planning to leave for Europe within 2 days. The court ordered him held without bail. He was deemed a flight risk, a British citizen with $500 million in assets. On Wednesday, Grant Thornton withdrew its certification of REFCO's financial statements. The auditors that had signed off on REFCO's books for years had been deceived for years. On Friday, October the 14th, exactly 4 days after the disclosure, REFCO filed for Chapter 11 bankruptcy. It declared assets of $49 billion, then quickly revised them to $16.5 billion. Either way, it was the fourth largest bankruptcy in American history at that point. The company that had been worth $3.5 billion 2 months earlier was now worth nothing. Wall Street was stunned. Goldman Sachs, Credit Suisse, and Bank of America had vouched for REFCO's IPO 8 weeks earlier. Grant Thornton had certified its accounts every year since 1998. Thomas H. Lee Partners had paid $500 million for a stake 1 year before. None of them had seen the fraud. The investigation revealed that the simplest, most elegant fraud in the world had hidden in plain sight for 8 years by exploiting nothing more than the timing of quarterly reports. Phillip Bennett pleaded guilty to 20 counts of securities fraud, wire fraud, money laundering, and conspiracy. In July 2008, he was sentenced to 16 years in federal prison. He was 60 years old. He was joined in prosecution by REFCO's former president, Tone Grant, who received a 10-year sentence, and former CFO, Robert Troston. Together, the 3 executives were responsible for hiding nearly $500 million from investors. The fallout extended far beyond Bennett. Grant Thornton, the auditor, faced years of lawsuits. The firm survived, but its reputation took a significant blow. The case became a textbook example of audit failure, not because the auditors did anything illegal, but because they trusted the timing. Thomas H. Lee Partners lost its $500 million investment almost entirely. The IPO investors, pension funds, hedge funds, retail investors, collectively lost over $1 billion. Lawsuits against Goldman Sachs, Credit Suisse, and Bank of America for negligence in their underwriting roles dragged on for years. And REFCO itself? Its assets were sold off in pieces. The futures and commodities business went to a company called Man Financial, which later renamed itself MF Global. MF Global, in 2011, would itself collapse in another scandal involving missing customer money. The story doesn't end cleanly. Phillip Bennett is still in federal prison. He is scheduled for release in 2024. Here is what the REFCO story actually teaches. Sophisticated fraud doesn't require complexity. The REFCO scheme used basic accounting concepts that any business school student understands. What made it work was patience and precision. 8 years of executing the same simple maneuver at exactly the right moments. The most expensive due diligence in the world failed. Investment banks, lawyers, auditors, private equity, all of them looking carefully at the same financial statements. They were all looking on the wrong days. This is the lesson that connects REFCO to Enron, to WorldCom, to Wirecard, to FTX. Fraud doesn't survive because it's complicated. It survives because it understands what the regulators are looking for and shows them exactly that. The space between the reporting dates is where the real story lives. Next week, I'm covering Wirecard, the German payments company that hid $2 billion on its balance sheet that turned out not to exist. The story is, in some ways, the European version of REFCO, but it's stranger, darker, and the man who designed it is still on the run. Subscribe so you don't miss it. Thank you for watching Ruins and Reason.